All right, let's jump right in. Today, we're breaking down an analysis that gives us a strategic roadmap for the Indian stock market in May 2026. We're going to uncover the key sectors and, of course, the top stock picks that this source is highlighting. Let's get to it.
In a market as dynamic and, let's be honest, as wild as India's, this is the million-dollar question, right? So let's see exactly how this analysis tries to answer it, and we'll start with the big-picture economic environment.
So first up, the overall market outlook. The source makes a great point here. Before you can even think about picking a winning stock, you have to understand the field you're playing on. This really sets the stage for everything that's about to come.
So what does a mixed trend actually mean? Well, it means the market isn't just one big wave lifting all boats. Not at all. Some sectors are absolutely crushing it, surging ahead, while others are facing some serious headwinds. For an investor, this means you can't just throw a dart and hope for the best. You got to be a bit more like a surgeon to find those pockets of real opportunity.
Okay, so the source points to four key things pushing the market. First, we've got Q4 earnings rolling in, which tells us how healthy companies are right now. Then, there's all the buzz around the upcoming budget, which always creates a lot of anticipation. You've also got this really strong base of domestic buying, which kind of acts as a safety net. And finally, sector rotation, which is just a fancy way of saying big money is moving from one industry to another, creating these new hotspots of momentum.
And that's the perfect question, isn't it? If the market is a mixed bag, where do you even start? This is where the analysis gets really specific. It's not about buying the whole market, it's about pinpointing those areas of strength. Let's see where they tell us to look.
All right, so we're zooming in now. We've gone from that 30,000-foot view of the entire market right down to the specific playing field. This next bit is all about the industry groups that the source believes are really set up to outperform. And this, I think, just lays it out beautifully. You're looking at two totally different kinds of opportunities here. On the left, you've got the sectors that are just plain strong right now. Banking, power, defense, and auto. These have momentum. But then on the right, you have a completely different kind of play, the IT sector. The thinking here is to buy the dip, basically seeing a recent downturn as a golden opportunity to get into a quality sector for the long haul. And now we're getting to the heart of it all. This is what you've been waiting for. We're moving from broad sectors to the source's top 5 specific stock selections. Let's see how they connect back to everything we've just talked about.
This table is a fantastic little cheat sheet. You can see we've got 2 picks from that strong banking sector, 1 from power, 1 from auto, and of course that long-term play from IT. And I love the keywords for why they were picked: growth, valuation, defensive, recovery, and long-term. Let's dig into the thinking behind each one.
First up, ICICI Bank. According to the source, this is your classic growth story. The bank has been putting up really strong, consistent numbers, proving it's stable, and that's what makes it a top pick inside that powerful banking sector. Next, we've got another banking giant, HDFC Bank, but the angle here is a little different. The whole game here is about value. The source sees it as a true market leader that, at the time, was trading at a really attractive price. It's like a chance to buy a premium brand while it's on sale. Moving over to the power sector, we have NTPC. Now, this one's interesting because the source views it as a kind of 2-for-1 deal. It's defensive, so it might hold up better if the market gets choppy, but it also has that growth potential tied directly to the country's huge and growing need for more power.
For Tata Motors, the story is all about a powerful comeback and future growth. The source is highlighting 2 huge drivers here. First, the incredible expansion of its electric vehicle business, and second, the big turnaround in recovery of its luxury brand, Jaguar Land Rover.
And finally, Infosys. This brings us right back to that buy-on-dip strategy. The logic is simple. The whole IT sector has taken a bit of a hit on price. The source doesn't see this as a problem, but as a strategic opportunity to get into a high-quality company like Infosys for its long-term potential.
But wait, there's more. The analysis actually tosses in a bonus category. This one's for investors who are okay with a bit more risk, in exchange for potentially higher growth. Let's see what's on this list.
So the source drops 3 names here: HAL, Bharat Electronics, and Mahindra & Mahindra. It's really important to catch that these are specifically for investors with a higher risk tolerance. They fit a totally different profile than those core 5 we just talked about.
Okay, so we've got the what, but what about the how? A list of stocks is one thing, but your approach to actually investing in them is just as important. And this source provides a really clear, disciplined strategy for how to do it.
And here it is, the 3-step game plan. First, buy in parts. Don't go all in at once. It helps manage your risk. Second, focus on quality.
Stick to fundamentally strong companies, like the ones we've been talking about. And third, and this might be the most important one, be patient. The source recommends holding for 6 months to 3 years. This isn't about quick trades. It's about smart, long-term positioning.
So after everything, looking at the market, the sectors, the specific stocks, the whole analysis really seems to boil down to one core idea. And it leaves us with this final, really important question. In a market that's just full of noise and mixed signals, is the ultimate key to success really just a patient, long-term strategy? Definitely something to think about. Thanks for joining us.